Have you ever wondered why some investors make incredible profits while others lose money investing in the same mutual fund? Well, the answer to this lies not in the fund itself, but in the mistakes that investors make. And today we will be discussing about the most common mistakes that people make and how to avoid them to make smarter mutual fund choices in 2025. Let me start with a story about Mr. Peter Lynch, one of the greatest investors of all time. He took over the Magellan Fund. Basically, it's a mutual fund in USA which delivered an astonishing annual return of 29% over 13 years during the time period which he managed the fund. But here's the crazy part. Many investors in his fund lost money. Well, now how could this even happen despite the fund gave crazy returns, still people lost money? Answer to this is simple, that the investors who suffered losses let their emotions decide their decisions. They jumped in when the fund performed well and sold in panic when the markets dipped. The same mistakes are people making today. And if you are not careful, you could be falling into the same trap. But don't worry, this video will help you identify and fix those mistakes before they could cost you your hard-earned money. With that said, let's get started. Mistake number 1 that people frequently make is chasing past performance. Most investors pick funds based on their past returns, thinking if this fund gave, let's say, 25% return last year, it will do the same this year as well. But here's the truth, that past performance is not a guarantee of future results. Solution to this is, instead of chasing returns, look at the fund's consistency, its expense ratio, and how it performs in both bullish and bearish markets. For example, a fund that delivers steady 12 to 15% return over 5 years is often a better choice than one with extreme highs and lows. Mistake number 2 is over-diversification. Imagine owning 15 mutual funds thinking that it reduces risk. But here, the issue is that most funds already invest in a wide range of stocks. So what you are doing here is just duplicating investments and paying for the management fees multiple times as well. Well, over-diversification dilutes your returns and makes portfolio management unnecessarily complicated. Solution to this is just stick to 3 to 4 funds that align with your goals. For example, let's say a 25-year-old with high risk tolerance can make a portfolio of about 40% small caps, 30% mid caps, and 30% large caps. Whereas for someone who is near to the retirement, he cannot take high risk. So he would make a portfolio of something like 60% large caps, 30% debt funds, and 10% in balanced funds or in fixed deposits. Point here is, portfolio management would depend upon your risk appetite and your goals, not on how many mutual funds you are invested in. Mistake number 3 is short-term investing in equity-oriented mutual funds. Equity funds are by definition designed for long-term growth, at least for 5 to 7 years of investment horizon. But many investors panic when markets dip and pull out their money within a year or two, as a result booking in losses. For example, during the 2020 COVID crash, many equity fund investors sold at the bottom only to see the market recover and hit all-time high later. Solution to this is, for short-term goals, choose safer options like liquid mutual funds, fixed deposits, or even corporate bonds. Save equity funds for long-term wealth creation. Mistake number 4 is being too active. Many investors constantly tweak their portfolios trying to time the market, but research shows that more you trade, the lower your returns will be. For example, a study in United States found that the average investor earns about 4% annually, while the S&P 500, the broad-based index of United States, delivered over 10% returns. The reason was overtrading. Solution to this is focus on growing your income, automate your investments through SIPs, and let the compounding do its magic. You just have to trust the process and be patient. The final mistake that people make is choosing funds based on its size, that is, It's AUM, assets under management. Many people think bigger funds are better. But here's the catch. For small cap funds, managing too much money can actually hurt performance because fund managers struggle to find enough quality small cap stocks to invest in. So don't judge a fund solely by its size. Instead, check its portfolio turnover ratio, expense ratio, and consistency in returns. A small cap fund with rupees 200 crore AUM might perform better than one with rupees 10,000 crore. By avoiding these 5 mistakes, you can maximize your returns and reduce unnecessary stress. Since 2025 is round the corner, here is how you can build a winning mutual fund portfolio in the upcoming year. First, stick to funds with reasonable expense ratio. Second, plan your investments based on your goal, short term, medium term, or long term. Third, stay invested during market dips. Volatility is your friend in the long run. Remember, investing isn't about quick wins. It's about creating a secured financial future. And with the right strategy and patience, you can achieve that. Now, it's your turn to take control of your financial well-being. Take a look at your current portfolio. Are you making any of these mistakes? If yes, it's time to make some changes. Let me know in the comments below which mistake you have made before or which solution you found most helpful. And if you want more actionable insights on personal finance and investing, hit that subscribe button. Do consider liking the video and sharing it with your family and friends. Together, let's make 2025 your most financially successful year. With that said, wishing you guys a very happy new year. Thank you so much for watching the video. I will see you the other side. Thank you.